Welcome to another Fast Grass Friday quick stock analysis, and today we're looking at Regeneron Pharmaceuticals.
I'm amazed how many people own stocks. I'm amazed how many people own stocks.
Welcome back everyone, my name's Paul. Today we're going to do a quick stock analysis on Regeneron Pharmaceuticals. Now Regeneron looks like it's some sort of cancer or anti-autoimmune system pharmaceutical company. This is mainly because the two top drugs all end in MABs. So whenever you see a drug that ends in MAB, it's usually some sort of protein recognizing type drug. So it's looking for a cancer or it's boosting some sort of antibody inside the body. I'm doing Regeneron because it was done by request, and if anyone wants me to go through any other stocks on here, anything at all, really hyper growth stocks, I'll try my best. But feel free to comment below with a request to see if you want me to go through any company on Fast Graphs. Can be hyper growth, anything. But today by request we're looking at Regeneron Pharmaceuticals. Now today we're not going to look through any real qualitative data. We're not going to go into any of the pipeline. But pipeline with a pharmaceutical company is really, really important. Just remember, if you find anything interesting in this company right now within its fundamentals and you're thinking, oh, this might be a buy, then remember that you need to go and have a look at their pipeline and understand exactly what this company does before you should start investing. Once you start to get really comfortable with the company, then it should really only be then that you consider getting into Regeneron Pharmaceuticals. Now, quick reminder of my criteria. I try to look for top line revenue growth. I look for EBITDA growth. I look for justifiable debt. I'm looking for free cash flow as the most important thing for pretty much any company, really. Then I'm looking at analyst forecasts, and then we'll be looking for a price that we can go for with Regeneron Pharmaceuticals by looking at its value. Usually what I first look at is the shares outstanding, and it looks like Regeneron has been issuing shares for the long term, as you would expect it to, but over the past 10 years it has been very flat, with only really adding 3% shares over the past 10 years. Over the past 5 years they haven't added anything. They're really flat over the past 5 years, which is pretty nice. Top line revenue for the past 10 years, absolutely tip top. Look at that amazing growth, jumping from 6.5 billion to 8.5 billion in the last year. I would be keen to know exactly what was going on here. It could be a vaccine related thing, I'm not sure. But also, when you do see a spike like this in a company's revenue, it can be that they've taken on or acquired a new company, particularly pharmaceutical companies. Pharmaceuticals generally grow by acquisition. They find companies that are developing new and exciting drugs, and then they buy them. And when they do buy them, the revenue that's growing from that company becomes the revenue from the new company. And sometimes you'll see these big revenue spikes when they make an acquisition. I don't know what they've done. I've got a feeling it's vaccine related, because on their website, the first thing that they brought up was Regeneron antibody cocktail. So there might be something there. They might be growing something there. Something for you to consider in the future. I always look at EBITDA because I think it's a really good way of figuring out if a company is growing without having to look at taxes and debt and all that sort of thing. And over the past 10 years, this company has been growing. It's going from negative EBITDA all the way up to really high positive EBITDA. And over the past 5 years, we're seeing a 25% growth in their profit there. That's pretty good profit margin. Next, I want to look at total debt, and something again has happened in 2020. We don't know what, because debt was pretty good for the past 10 years. Been really, really low, 714 million. And in 2020, it's bounced to 2.7 billion. I'm sure that's justified. Again, we don't know what it's for. Could it be an acquisition and they've taken on a lot of debt from another company? There's lots of things to consider there. I'd like to know what's going on here. It could be something as simple as one of their drugs took off and they needed to very quickly bring it to market, and what they did is they put on a lot of outlay there to try and get that new drug out there. I don't know, but that's an interesting debt spike in 2020, particularly as the revenue has gone up at the same time. You might want to consider that one. And free cash flow is another thing I look at. Most important thing for a company is free cash flow, in my opinion. These companies either need to be paying off debt, they need to be paying out to shareholders in forms of dividends or share buybacks, in my opinion. If you're investing in a company, these companies should be giving something back to you. That's what I believe. If they're not, and they're having to always reinvest for growth, then while some of those companies do exceptionally well, all we're doing really when we're buying into these companies, particularly mature growth companies, what you're really doing is you're buying a company at a certain price and hoping that someone pays more for it later. It's not the way I work with businesses. I'll explain that hopefully in a future video, but at the moment free cash flow is definitely growing, flat in 2020. Obviously a lot of payments came out here, something that would need to be looked at. 2020 saw a very big spike in revenue growth somewhere, so again it will be something to consider. And if it is something that's vaccine related, or if it's COVID related, then you might want to consider, does this company have a future after this? By the looks of things, they've got a lot to talk about, so there might be something here. It's all going to be down to you to figure out how big and what their pipeline is, and you can find that by going usually into the investors section. And in the investors section, it'll tell you all about the current drugs that they've got, and pretty much everything is a mAb, so everything is protein derived. And if you click read on, I imagine there will be a pipeline layout for you there, and it'll tell you everything that these drugs do. Okay, let's get to the good stuff. Looking at the graphs, this is a company that's way over 20 years old and never been profitable until 2011. So let's drop it down to 2011, 2012, so we can get a really good idea of what this company is growing at. And it looks like this company grows at a PEG ratio on average of about 17 times earnings, which is definitely what we'd expect, considering this is apparently quite a high growth company. That's very good. Long-term debt to capital is 19% with a credit rating of BBB+. So that debt I was talking about earlier, even though it was quite a big spike in debt, it really doesn't make a difference to Regeneron right now. Their debt looks like it will be quite normally managed. It's worth looking into at the interest rates, but at the moment interest rates are so low, so I can't see a company like this really falling into a debt problem from a big one-off outlay like it has. I love looking at free cash flow, and if we're looking over the past 7 years, and this is very important with something like FastGraphs, is that it uses a calculation based on the data that it's given. So in FastGraphs, if I make the timeline a little bit too long, it changes the calculation and it changes this company into quite a low growth company, and it sets a default PEG at 15. We don't really want that. If I bring it all the way up to 2014, I think we get a much more accurate version of what the price to free cash flow is at the moment. And currently FastGraphs is rating a normal free cash flow growth of 24 for Regeneron Pharmaceuticals. This is based on Peter Lynch's forward P formula. This will be the price to free cash flow growth. Same formula, just applied to cash flow instead. I'm not a big fan of PE ratios, and I don't think any of the hyper growth fans are. And I can totally understand that, because earnings per share can be very easily manipulated by share buybacks and many other things. And Peter Lynch's PEG ratio, PE growth ratio formula, is actually based heavily on EPS. So it's just something that, of course I will take into account, but I think price to free cash flow is so much more important than a PE ratio. And what we've seen over the past sort of 5 years is actually quite a stagnant share price on this one. No dividend yield by the looks of things. So this is a growing company. They see themselves as a growing company. And if we go back to 2010, we are seeing a good example of what we call mean reversion. And this does take years, guys. This is something I'm kind of banging on about quite heavily when we're talking about these hyper growth stocks. Everyone gets very, very excited when these companies start to make money, and the market values these companies way, way over what they should be. And this is what's happened to Regeneron Pharmaceuticals right here. As soon as it started getting a sniff of cash flow growth and of earnings growth, the share price shot up, and we're talking price to cash flows of 100, 90, 100, 104. These are quite ridiculous price to cash flows, and it's all down to the excitement around the company. And I tell you what, the people who bought in right here were right, because the cash flows have started to compound forward. It has taken 5 years to get to this point, but when we found out it wasn't going to exponentially grow as much as everybody said it would, the share price just kind of went flat. In fact, if you had bought it at the peak here in 2015, and managed to sell somehow in the market crash of March, then you would have lost 13% year on year at a total of 45% loss. And that is on a really, really good company. It looks like this company has a lot of earnings and a lot of free cash flow potential. The forward looking in this company looks really good. And what we've seen, because I'm going to bring it down back to 9 years now and really try and cut out those years of negative growth. What we've seen is this company has reverted back to its free cash flow area. This is free cash flow of 24, quite a high price to free cash flow. 20 is a really good number, especially for a high growth company. But you can see what the share price has done. Everyone got really excited and started trading at a price to free cash flow of 104. And then news just kind of ran out on Regeneron. And over the years, you started to see this slump. And there's no reason to think you should be selling during this period. You shouldn't really be selling during this period, because we know that eventually this price to free cash flow is always going to go up because this company's good. This seems like a very good business at the moment. Even if we did buy right at the top here, when things got really exciting again, we started to see a little bit growth. You would see this 2% year on year. So even in high growth companies, if you buy them at the wrong valuations, and Regeneron is a really, really good example of this. If you buy these high growth companies at really bad valuations, you are not going to earn money of them, no matter how good these companies are. And I don't think I've ever actually seen a company, and I've looked at so many fast graphs now, I don't think I've actually ever seen a company break this rule before. However, free cash flow is going up. It looks like it's had a really good time through lockdown, really benefited from the crash. And where was this? 31st of the 7th, 2020. For some reason, it still hasn't satisfied the investor hopes, and the price is all coming back down to the free cash flow line again. So this company is looking like it's close, possibly, to being at fair value again. Let's take a look at the forecasts. Now, this company's earnings going forward to 2023 are rated by 25, 24, and 17 analysts each year, which is a lot of analysts looking at this company. So this would be the average rating of this company based on 25 analysts. I'd say that's quite a good and large pool of information to gather from there. And what they're thinking is that Regeneron this year has grown 28% in earnings. Next year, it'll have a good 45% rise. The year after that, it'll be down 11%. That's from the highs of 45%. And then after that, it will grow at 2%. These are the analyst estimates, everyone. This is what everyone thinks this company is going to do. And with that in mind, it's currently trading at a PE of 13, so that's pretty good from a PE ratio. Apologies, I don't have the cash flow ratio on this one right now, but I think, like I said, it's probably around 2024 right now. And if it stays at its average PE of 13.50, you could see a very safe return of 6.23% a year on year. That's a total capital appreciation of 18%, but it has previously traded at a PE of 23. And if this company is as exciting as what everyone says it is, then if this company was to start trading at 22 and that expansion continues going forward, we could see a capital appreciation. This is best case scenario right now. We could see this capital appreciation of almost doubling your money and earning 27% year on year. That's massively market beating, everyone. You've got to remember that. This company, if it does brilliantly, and it has to really do brilliantly, I think, and this company could earn you 27% year on year. Safety wise though, if this company does fall to a PE, like something goes wrong, you could end up losing money with this company. Another way you can look at this is how investors have previously voted on this. And I say voted because short term investing is voting, long term is fundamentals, long term it's a weighing machine. If we do look at this company in the same way that people have previously voted on this company at a PE, NPE, a terminal PE of 21. Remember, these numbers here are all PE expansions. To very quickly describe that, I'll say that this, the higher the PE expansion is, the more people are willing to pay for these stocks in comparison to their earnings. It's essentially, in my opinion, how popular these stocks are going to be in 2023. And when things are really good, the market usually rates Regeneron at a PE of 21. Now, if Regeneron was to again expand to this 20 PE with its current estimates growth rate, again, you'll start to see 27% and almost 100% return on your money by 2023, if that's what it wants to do. Currently, it's sitting at a price of $471. And if we assume that it stays with no share buybacks, by 2026, this company could be trading at $2,000 per share based on its historical return of 21%. And I'm just going to make it a little bit harder. Let's say that COVID was just a good year and this company isn't going to continue to grow at the same rate. What we're trying to find here is a worst case scenario and see if that is still good reason to invest in this company. And right now, if I say that next year and the years ahead, this company only grows at 10% year on year, and we say that this company now gets less popular and comes down to a PE of 15. I'm looking at this and I'm thinking with Regeneron, you still have the potential of getting a 10% year-on-year return. That's a market-beating 10% year-on-year return. Regeneron Pharmaceuticals, based on its fundamentals, is not a bad stock to look at, especially within this situation where you can consider that this might be a worst case scenario, at a scenario where it doesn't really trade at a PE of 13 very often, and it's not likely to continue to trade at a PE of 15 in the future. It's very possible the PE will expand to closer to 20 in the future based on its history. And if this company really does continue grow, biotechnology is going to be a very, very important sector coming in the future. I think our lives are definitely going to change with biotechnology, in particular in protein recognizing drugs. And I think everybody knows this. This company may be a safer bet for the future, because even if the PE ratio expansion comes down, and this is at a 10% growth, remember, this is less growth than it's been feeling over the past few years. If the PE ratio comes down to 12, you still have the possibility of a 6% year-on-year return, which is going forward very likely to be beating the S&P 500, which over the next few years with rising interest rates and all that sort of thing, in the S&P 500, it's very likely that you'll only receive 5% year-on-year going forward. So if we are calculating these at quite bad situations at 10% year-on-year return, Regeneron has the possibility, and this is just me looking at these fundamentals here. This is just me looking at historical performance. Definitely go out there, have a look qualitatively at Regeneron Pharmaceuticals. Decide if you think you can learn a lot about this company and a lot about the drugs. I bet it's really good to be in the medical sector when you're looking at these drugs, or in the pharmaceutical sector. Looking at these pharmaceutical companies, you can really get an idea of how these drugs are selling firsthand. If you're in that sort of position, you think you can learn and grow with this company, then Regeneron might be something to think about. Thank you very much, everyone. If you enjoyed this video, please feel free to like and subscribe. And if you wanted me to look at any other company in this way, this is not just about buying below the orange line. This is still something you need to go out and look at. So don't just think that this is the be all and end all of buying a company. If you wanted me to look at any companies, feel free to leave a comment with the company you want me to look at. And if you enjoyed this video, please feel free to like, subscribe, and invest. Thank you very much.
I'm amazed how many people own stocks. I'm amazed how many people own stocks. The sucker's going up.